Donald Trump met his Chinese counterpart Xi Jinping in South Korea on the sidelines of an Asia Pacific summit yesterday. Markets rallied ahead of the talks, hoping for de-escalation in the trade turmoil. A sketchy framework for a deal was said to be agreed, and a one-year truce emerged on several issues. China will buy more American soybeans, great for Trump-friendly farmers, and will delay implementation of restrictions on exports of rare earths, for which it has near monopoly on. But analysts conclude that given that past bargains between the two superpowers have never lasted very long, it's not so clear what makes this different. Others suspect the US seems focused on tactical matters, while China seems to have a better strategic grasp of how it intends to win the longer-term technology-driven war. Details were also scanty on some areas, like, for example, chip restrictions, beyond the broad agreement to relax some of the more combative measures. US Treasury Secretary also confirmed that China has approved the transfer agreement for the short video app TikTok. Treasury Secretary Scott Bessent added that he sees progress in coming weeks, but still giving no further details. Hello, this is Global Business Insights, where we consider headlines of more global interest and bring perspectives to enrich understanding of today's somewhat more challenging context to support corporate decision making. Markets were underwhelmed as analysts lamented the absence of any strong structural foundation, suggesting both the US and China could be tempted to reverse gear should the need arise. According to the readout, Xi Jinping said China's development goes hand in hand with America's vision to be great again. To serve the purpose of yesterday's meeting, that may be so, but there is a different battle raging for tomorrow, a war to dominate the future high-tech space with far-reaching geoeconomic implications, which both believe they can win and both think it's too early to raise the white flag. Still, a truce that arrests any immediate deterioration in tensions is good. The Chinese are pausing rare earths export restrictions, like I said, for a year, promising to make progress on combating fentanyl as they push Washington to roll back anti-China rules. For example, that which exposes Chinese subsidiaries to curbs and several sanctions. Rare earths are critical for high-tech manufacturing of smartphones, jet engines, and high-tech cars. China will also resume buying US soybeans, like I said, expanding agricultural trade. Taiwan was not discussed, and Trump will leave Nvidia to sort out the ban on its more advanced chips. Treasury and Commerce secretaries will be working together with the Chinese to convert all the more tactical concessions into a comprehensive deal, most likely ahead of Trump's visit to China in April. I wouldn't hold my breath. The US-China trade truce in South Korea still brings the relationship a long way from when 145% tariffs were slapped on Chinese goods with a 125% retaliation levy from China. Now, overall duties on Chinese goods are down to 47%, and expanded restrictions on many blacklisted entities will be postponed for a year. Everything looks up for renegotiation. After a year, the US will suspend the extension of its technology-related export controls to Chinese subsidiaries that was announced late last month, again for 1 year only. The US also agreed to suspend recently levied port fees on China's maritime logistics and shipbuilding industries for a year. Both sides have not given up much. China's excess industrial capacity, alleged market barriers to new foreign entrants, aggression towards Taiwan, and the outright ban on Nvidia's advanced chips still stands. On the US side, it recently revved up its aggression by announcing it will resume nuclear tests to be more battle ready. Even if the truce lasts the 1 year period, it would have little impact on the balance on global competitiveness. Also, all acknowledge China has the momentum on its side, and the technology edge of the United States, if it still exists, is fast being eroded. Both see that there is no return to the pre 2017 era of interdependence and normal engagement, with a new normal somewhat closer to a state of adversarial competition. The world is at the cusp of huge transformational artificial intelligence driven change, and that is set to upend the status quo, presenting vast new competitive advantages that are yet to be fully understood. The grounds of cooperation between the US and China have been severely eroded not just by distrust, but also as more countries turn away from globalization and the liberal internationalism that helped China's spectacular ascent. China's success came despite its distinct political and economic model that seems to have managed better what some have called the dislocations brought to US and European societies, leading to a domestic backlash in much of the West. The US and China now currently share the position that economic efficiency alone does not justify reliance on each other's financial systems, critical goods, or technology. However, China began adopting this approach several decades before the US woke up. In recent years, the US has imposed export controls aimed at restricting China's technological development. However, China continues to make impressive advancements in technology. China now believes it can win the technology war of tomorrow, and the US is nervous. China does not need the US monetary and financial systems as much as it did 10 years ago, and is winning itself as fast as it can from US technology. The United States has been comparatively slower in responding to the widespread dependence on affordable, high-quality Chinese products such as solar panels, electric vehicles, toys, and clothing. And to be fair, the Chinese work much harder to sell abroad than a more domestic-oriented US. But that may also be changing. The agreement this week, you could say, preserves a fragile balance, but a lot will change in a year's time. My sense is that the trajectory on artificial intelligence, especially in the US, has the potential to make a huge difference. There are considerations regarding whether China should have access to Nvidia's most advanced chips. Limiting access could encourage Chinese research efforts to develop faster their own AI ecosystem and be able to compete, if not go ahead of Nvidia. AI requires significant investment, and while China is focusing on BRICS and Asian markets, US companies like Nvidia and OpenAI are rapidly expanding into Europe, Japan, South Korea, Malaysia, the UK, UAE, Qatar, Saudi Arabia, and Australia. Trump's intense and aggressive promotion of artificial intelligence in the US, combined with strong support from capital markets, may also give the US some advantage over China. There are other issues. China built a strong competitive edge based on a clear, consistent strategic core, and thanks to state-encouraged innovation and a consistent nationalism that also played the globalization card far more strategically. The West, on the other hand, is caught in many toxic social divisions. The US government shutdown, France's political turmoil highlight the much wider geopolitical tensions that are playing out in Western societies. Artificial intelligence is an area that is developing rapidly and extends beyond current robotics and digitalization. We are approaching a far different revolutionary era. AI-driven robotics and intelligent assistants will aid skilled humans and not replace them, but the skills are going to be vastly different. Currently, the US is considered to have an advantage in investments related to AI infrastructure and more advanced capabilities. Training AI systems require significant computational resources, making the size and capacity of data centers increasingly important. While China may have less infrastructure in this area, the gap is not substantial. Anecdotal evidence suggests Nvidia's latest chips are at least 3 years ahead of China's alternatives, though that gap may close quickly. Meanwhile, a truce provides reassuring optics that suggest both sides are seeking wider agreement, though it is deceptive. A more clear-eyed perspective shows that both China and US see ways of winning the war to lead the future tech space with far-reaching geopolitical and defense implications. Both sides are intent on doing whatever it takes to assure their victory and can't see how a path of mutual collaboration advances this cause. So what does this mean for business? First, global business needs to be more sensitive to the risk implications, as many possible scenarios could play out. This truce cannot be seen as the last word. Flexibility in supply chains can be helpful to managing risks. Heavy exposures to China, the US, and their strong allies can lead to vulnerabilities should we see a deterioration in Sino-US tensions. And countries and corporates need to understand how to position with neutrality in mind. That is, actively partnering, fully cognizant of potential risks associated with the new Cold War developments. Countries, especially in emerging and developing economies, also need to reassess their dependencies in strategic items like vaccines, semiconductors, and important electronic components, and accelerate any needed corrections. Finally, this truce is more likely to precede a different phase of rivalry rather than be the end of it. As China strengthens sourcing of non-dollar financing and accelerates research and tech investments, and as we see further nationalization and friendshoring to win the US off dependencies on a wider range of strategic goods, global trade and direction of flow of goods and services are being reshaped. We could be seeing the emergence of a different, reglobalized world. Analysts will continue to be of the view that executives should more than ever focus on creating more resilient organizations to navigate what remains a historically volatile environment. To other parts of the world, this time Europe, the European Central Bank at its latest meeting that was yesterday kept interest rates unchanged at 2% for the third meeting in a row as it enjoys a rare period of low inflation amid still tepid economic growth despite lingering trade turbulence. Meta is reported to be planning to raise $25 billion from a bond sale to help pay for soaring artificial intelligence costs as big tech continues to come under scrutiny on its high AI spend. Citigroup and Morgan Stanley could be raising the $25 billion in debt, ranging from 5 to 40 years in maturity, in what could be one of the biggest bond sales of the year. And in Nigeria, the Nigerian National Petroleum Company Limited, NNPCL, yesterday said it had begun yet another comprehensive review of Nigeria's 3 petroleum refineries with a view to bringing them back online. The group CEO of the NNPC, Bayo Julari, stated that one of the options being explored is to search for technical equity partners. In Asia, stocks in Japan led gains as investors assessed a truce between Washington and Beijing following the meeting between Trump and Xi Jinping. China's manufacturing PMI also contracted more than expected, shrinking to its lowest since May. Well, that's all on this very special episode of Global Business Insight. Do enjoy the weekend. This is Bode Oshosani. Bye-bye.